All right. Hi, everyone. I'm Kailash Jain. I am a new hire here at Columbia. So I would like to remind everyone to mute themselves if they haven't already. And if you could, please turn on your camera because I think it'll help with participation and creating an interactive session. So today we have Wang from Temple presenting an interesting paper on operating leases and loan contracts. So Wei, please go ahead and get started. You have an hour.
Okay, thank you, Kailash, and congratulations on your new job. And my name is Wang. I'm from Temple University. I'm very privileged to represent our team to present our paper as part of ADP. Um, I just wanted to thank everybody for being very generous in advance for their time and their feedback. Okay, so we know lease accounting has been a pretty contentious topic. It might be even fair to say that how to account for leases has attracted a lot more scrutiny and interest than the leasing itself. ASC 842 is the latest effort by FASB to improve the transparency of lease accounting. So beginning January 1st, 2019, all publicly listed companies were required to recognize operating leases on their balance sheets as right-of-use assets and corresponding liabilities. And prior to ASC 842, this on-balance sheet recognition, or in the parlance of accounting, capitalization was not allowed. And what this new standard implicitly assumes is that booking things onto the balance sheet invariably provides additional information. It is in line with FASB's growing emphasis on the balance sheet approach to accounting. And implicit in the standard, and which is largely untested, is the assumption that lease expense, which has already been recognized on the income statement, right, as part of operating expenses, the lease expense is not adequate. And therefore, we need to book those lease expenses onto the balance sheet as lease liabilities and assets. And a lot of prior research examining if and how capitalizing operating leases is net beneficial tends to exclude lease expense from their models, as if lease expense doesn't really matter. What we try to do in this paper is to answer this basic question: whether capitalizing operating leases provides, in the words of FASB, significant benefits over lease expense that's already recognized in the income statement. So why do we use private loan contracts? Yes, Aya.
So I think I have a question from your first slide. Is that the FASB right now is still thinking about R&D expensing versus capitalization? So going back to your earlier slide, when you
I'm trying to go back.
Operating leases, expensing the income statement, whether that is adequate compared to capitalizing those lease assets in the balance sheet. Do you see your study has some implications for the current debate about whether we should move from R&D expensing to capitalizing R&D?
I think so. I will get to sort of how our paper fits this ADP research agenda, and one of the ways in which we sort of align with ADP is we kind of contribute to this income statement versus balance sheet approach, right? Now, I do think R&D is different from operating leases, right? Because lease expenses are highly correlated. You can easily predict how much future lease expenses will be based off today's lease expense. But you can't do that with R&D because R&D is inherently uncertain. So when you have very certain future cash flows underlying operating leases, so that's where the income statement is sufficient based on our findings. Right? Capitalizing lease expenses onto the balance sheet, it's not harmful, but it is costly, and it is not incrementally informative beyond what the income statement already provides.
Because
So
I think that would be kind of like counterintuitive to, at least my prior, is that when the future cash flow are kind of more certain and also more predictable, then we are more likely to come up with a reliable estimates to capitalize those future cash flow in the balance sheet. But I think you're
absolutely,
actually
yeah.
arguing the opposite, is that when it's very certain and predictable, then we don't need to capitalize it. Income statement will be sufficient or adequate. Is that how I interpret your argument?
Well, I mean, I think down to its core, it's kind of what we try to say in the specific context of operating leases. You don't need to capitalize operating leases, but we're not saying you don't you don't need to capitalize R&D, right? Because that's different. You probably wouldn't want to capitalize R&D because it is uncertain. I think you don't want to capitalize R&D. The reason people might not want to capitalize R&D is different from the reason why people don't want to capitalize operating leases, right? You capitalizing R&D will be very prone to errors because future cash flows are very uncertain. Capitalizing operating leases will be kind of redundant, if not costly, right? So they are for different reasons. But what we actually found out in this paper, which I will get to momentarily, is that if you were to put an imputed measure of operating lease liabilities, that is the balance sheet measure, into a model along with lease expense to explain low interest rates, there is no explanatory power. Okay. So, Klaus, I didn't mean to skip you because I realized you're the moderator, so you're the
Oh,
one.
no, don't worry. Don't worry.
So,
if you see
yeah,
the hands, go for it. Yeah.
I got too excited.
Yeah, we have one more question from Tong.
Yeah, thank you, Wei. So I really like Yang's analogy, right? R&D versus lease capitalization. So in the R&D case, I guess maybe the incremental information is the technical feasibility, right, or commercial success probability, right? And for operating lease capitalization, the incremental information is the discount rate, right? Because before the requirement in 2019, right, other information already there, right, in the footnotes. But however, by capitalization, basically you provide incremental information on the discount rate used, right?
Yes.
Yeah.
So that's where the tension might be coming from, as we argued. So one of the more important things that ASC 842 made publicly available is the discount rate. Now, if lenders found discount rate to be useful, maybe capitalization would provide incremental benefits. But that is inconsistent with what we find in the paper.
Okay.
So maybe lenders, because they already have access to borrowers' private data, and they are very good at making credit decisions based on all kinds of internal projections. Maybe they don't need information about discount rates as much as other investors might. So again, everything that we talk about in this paper is based off what we see from private lenders, whose data access might be different or even superior to other investors, right? But it seems as if lenders, despite their unique access to borrower data, despite their awareness of capitalization, they still prefer lease expense over capitalizing operating leases, as we can actually see both from our model as well as in the actual contracts. how they go about measuring operating leases in the context.
Okay, thank you, Wei.
Wait, one more question on this. So do you think that this would be different? You're looking at the private loan setting. Do you think this would be different in bonds or in anything involving an investment bank?
It could be different, but just kind of based on what we sort of, so the logic is the following. This is present. Let me go to my second slide, as talk about why we want to focus on private loan contracts, and hopefully the first bullet point will get to what you were asking for, Kalash. Okay, so why do we focus on private loan contracts? A practical reason is that we can model low interest rates, right? A direct, visible measure of how much lenders charge against borrowers, right? We can model low interest rates as a function of operating lease liability, that is the balance sheet measure, in comparison to lease expense, which is the income statement measure. We assume reasonably that the private lending market is efficient enough, right, to incorporate all that ought to be relevant to credit risks, right? Lenders are very good at doing that. Most lenders are. Now, if FASB were to be right, the lease liabilities should explain low interest rates better and then lease expense, because that's how you can see that these liabilities or unbalanced recognition provides additional information to lenders. Lenders have private information. There is no reason, in my point of view, to believe that lenders wouldn't want to use capitalization if they found it to be useful, right? They want to use it because they know about it and they can easily calculate capitalization. That's just because that's who they are. So to the extent that we don't find any evidence that lenders are using these liabilities incremental to lease expense, that suggests to us that lenders do not deem capitalized operating leases to be incrementally beneficial in comparison to lease expense. So if I were to extend this logic to other markets, I would say in general, lease expense would be sufficient, right? But it's hard to predict how ASC 842 would affect this phenomenon, because ASC 842 brings a lot of footnote disclosures into more salience. So that might change how public investors view things, because now they're just being, they just have more exposure to a lot of different things that were previously not available, right? Whether or not these items were useful or not, they will probably try to incorporate a lot of those new disclosures into their pricing power, into their price. So long story short, I don't know how bond investors or equity markets would react to ASC 842 per se, but I would think that if they were to do it correctly, lease expense might be sufficient to incorporate lease-induced risks that ought to be baked into their pricing.
Yeah, just to respond very quickly. So I worked on the credit ratings desk at Citibank before I started my PhD program. And so I was there right when the lease stuff was changing.
Okay.
And so what we would obviously use like a manual discount rate. S&P is a 7%. Moody's gives you a table of multiples that you would apply to lease expense to capitalize. So we would use those heuristics to come up with the adjusted debt to EBITDA multiples, right, to determine credit ratings.
Mm-hmm.
And so we would calculate it all ourselves. But once they switched standards and once it was all capitalized for you, we started just taking the number right off the balance sheet. And this was to explicitly determine pricing for bonds when we were doing M&A. And it was also there for private loans, like a bridge loan that Citi would make for an M&A transaction. And so just from real experience, I disagree that it did not have an impact. Now, I wasn't in commercial banking, right? And so I think your setting probably speaks more to commercial banking than investment banking. I see where you're coming from, that you should have enough information to kind of get at this in the ex ante state, but it did change our behavior It changed how we calculated these credit ratings. And so I think it does have an impact. And I think just because the interest rates are staying the same doesn't mean that the other margins are staying the same. And you even show this in your paper, right? The quantum of debt is changing, the covenants are changing. So I think the conclusion you're drawing is a little strong.
Yeah.
That's not to say the results are wrong. I think there's a consistent story to be told here, but the conclusion that the information is not having any impact, I think is a bit strong.
Cool. I guess, thank you, Kalash, for sharing your personal experience at Citibank. So I guess I was wondering, what would the counterfactual be, right? What would have happened if you, instead of putting the discounted future lease expenses, just put in current lease expenses? Would the results be different? So that's kind of the argument, right? So I know broker dealers as analysts usually would include the capitalized amount by discounting future expenses. But a counterfactual would be, what if you just include current lease expense? Does that provide the same kind of information?
Yeah,
I guess
so your point your point that they don't actually capitalize and add back the lease expense to the EBITDA, right? So they don't add it back in the denominator and they don't capitalize in the numerator is compelling evidence. Or if you had some actual evidence that they don't do that, I think you do from the lease contract terms, that suggests that explains why you may not find an effect. But we definitely did capitalize in the debt number and add it back in the denominator. So just some personal experience that I wanted to share.
So I'm gonna get to how loan contracts actually define operating leases. So that kind of helps us sort of tease out why lenders sort of seem to prefer lease expense over capitalized operating leases. Yeah.
Got it.
And speaking of which, that's the second reason why we want to focus on loan contracts, right? We can actually look up all those loan contractual agreements from the SEC aggregate, which is difficult to do for public bonds, let alone equity. And we can study basically how contracting parties go about defining and measuring operating leases when they write contracts. So, for example, if we see contracting parties consistently prefer, let's say, lease expense to lease liabilities when they write contracts, then we think that this review preference by the lender seems to suggest that lenders prefer one measure consistently over the other.
There's a question from Aya.
Wei, I have a question kind of related to your earlier conversation with Kalash. So when you try to kind of inform FastSpeed about the usefulness of this new standard of whether to capitalize, I want to clarify that what's your definition of usefulness, right? So from someone like Kalash working in practice, right? Analysts and users actually collect a voluminous piece of information to put together like a mosaic, right? And usefulness is defined as having that additional piece of information, for example, discount rate. Does that actually help them improve the precision of their decision? Right? And improving the precision doesn't mean that it's actually going to change from option A to option B. Doesn't mean that actually it's going to really change the interest rate they charge, but they do have better information about the counterparty. So I think that is one way to define usefulness, but that may not show up in a very strict way when you see a T set become significant in the correlation or covariance sense. So it sounds like your definition of usefulness can be a little bit disconnected with what the usefulness has been defined in practice or what FastSpeed has in mind. So I want you to kind of like give us a little guidance about why do you motivate your results as picking two line items one from balance sheet, one from income statement, and run a horse race, and then the incremental usefulness will be just strictly defined by TC. And how does that relate to what the users actually combine these two pieces of information in improving the precision of the decision, even exposed the decision doesn't really alter between alternatives? Does that make sense to you?
It makes absolute sense. Although it will be very difficult for me to answer this question. So I'm gonna go over. I think you guys know what my findings are, what our findings are. I'm just gonna go over this slide in terms of how we sort of add to the ADP, especially when it as it relates to the balance sheet approach versus income statement approach. Okay, so So AL mentioned earlier about R&D expenditure, right? So I think one of the takeaways from our findings is that capitalizing what the income statement already recognizes seems to provide little new information, at least in the context of operating leases. Now, what would be an alternative solution? So at least in the context of leasing, it seems like the solution would be just to make lease expense more visible on the income statement, right? We're not saying FASB got it wrong, but if you capitalize operating leases, which are already informative, it seems like the solution would be to make that lease expense more visible. So in both under the previous ASC 840 and ASC 842, lease expense, true, it is recognized on the income statement, but it's only recognized in such a way that it is included as part of operating expenses. You don't see that line item separately on the face of the financial statement, right? So if you were to animate lease expense to the body of the financial statement, so based on our findings, that would be maybe an equally informative, if not less costly. It certainly would be less costly solution to what FASB is doing now. But back to your concern about from where can we draw the inferences about usefulness. I guess to me, being useful means it helps decision makers make better decisions based on what they have. And I admit that we don't have enough evidence to say that lenders are making better decisions. We can only see that lenders are not using, right, one item as much as what FASB was to assume, right? They're using lease expense a lot more pervasively than capitalized operating leases, even after ASC 842 was adopted. Now, to the extent that there's little incremental information, it seems like if you were to bring that expense onto the income statement, it might serve the same purpose as what FASB was intended to.
So just a follow up, I think this is kind of more about how you claim and interpret your results, right? I think another way to interpret your result will be based on the regression results. We don't see this capitalized these assets and liabilities kind of co-vary with the interest rate spread across contracts, right? But you can tune down on whether that is usefulness, whether interest rate variance is better or worse decisions, right? Because those are normative statements that you don't really have a very good identification to draw inferences or have any theory to guide it. But like what you actually find is just that you don't see that co-movement between the interest rate changes and this one particular line item. The second thing I want to clarify is that whether a line item will be a standalone line item in the income statement or balance sheet, it probably is not directly related to the standard, but it's related to materiality, right? Even the lease assets and liabilities are capitalized in the balance sheet. Sometimes when we look at the financial statement, we still don't see standalone line item because that transaction is kind of like aggregated with other line items due to immaterial contribution to the firm's overall assets or liabilities. Is that correct? I think the standard doesn't really dictate whether they will be extra aligned for these asset or liabilities.
Yeah,
Firms just have discretion to aggregate it with other tangible assets or long-term, short-term liabilities, depending on how they think, how material that transaction is. Is that true?
Yeah, that's a good point. I haven't thought of this in terms of materiality. But like, if you were to ask companies to capitalize all these expenses onto the balance sheet, right? You're kind of saying they will be material enough to be on the balance sheet. It's hard to argue that capitalizing will be material, but not these expenses, right?
Yeah, but there are many transactions has been capitalizing the balance sheet, but we don't have that detailed line items, right? The line items you see from the consolidated balance sheet is not thousands of transactions that have been capitalized. It's usually condensed to a few groups. So it's
sort of like,
something I want to clarify with you that capitalization doesn't mean that you see a distinct line item in the balance sheet in the tank.
That's possible. It's also sort of like PPE, right? Like, so lease expense would be like depreciation. You're kind of matching lease expense to the revenues that the usage of lease would produce, right? So yeah, but I guess our solution is completely based on what we find, and in terms of sort of thinking about what FASB wants to achieve, that is to bring more information or let average investors be more aware of what these can potentially do to the company. So I guess it will be less costly to simply ask companies to report that expense on the income statement. But yeah. So if I may, I want to go back to the previous slide and just kind of quickly talk about what we find, so everybody is on the same page in terms of what we find. So many of you have mentioned already, so this is our main finding. Okay, we kind of pit, or we horse race between capitalized operating leases against these expenses. And we find that these expenses explains nearly all the variation in loan interest rates that are likely to be attributable to lease risks. Adding operating lease liabilities, the balance sheet measure, does not improve the model. Nor did we find any evidence that ASC 842 implementation changed how lenders choose between those two measures. So when we dig into the weeds of the contracts, so we actually examine how loan contracts define those lease measures. We found that more than 90% of the contracts do not include capitalized operating leases in debt. I think this kind of goes back to Kalash's point earlier, right? So in the context of loan contracts, we do find overwhelming majority of loan contracts exclude or drop out capitalized leases from its definition of debt. By contrast, almost all of these same contracts do include these expenses as part of earnings and EBITDA. We do find some unintended consequences of ASC 842. We found that because when you switch from ASC 840 to ASC 842, borrowers lost a lot of the off-balance sheet benefits they previously enjoyed. So what would have happened is those borrowers would have more incentives to go from leasing to borrowings, right? And we found that lenders would include more and stricter debt-based covenants to preempt this expected increase in borrowings that borrowers would do, right? So it's less to do with the fundamentals of lease accounting, but more to do with what lenders perceive the borrowers will do in response to the new standard. So in general, our results are consistent with the informative least expense hypothesis. That is, least expense is informative enough. And it is inconsistent with what we call an incrementally informative capitalization hypothesis. Kalash, do you have a question?
Yes. So for number 2, when you say that lease expense is counted as part of earnings in EBITDA, you're saying that they add back lease expense to EBITDA.
Lease expense.
They don't. Okay. So they're behaving internally consistently.
Yes.
Yeah. Okay.
They include lease expense as part of the expenses that was subtracted from the earning from the revenue, right?
Okay.
Unlike what they do with depreciation, amortization, interest, taxes, which they add back, right?
Got it.
That's what I mean.
Okay.
Yeah.
So the earnings in EBITDA is burdened by lease expense.
Exactly. So lease
Okay.
expense are part of
That makes sense.
that lenders do count, unlike the depreciation of the world. Right.
Yeah. So one thing I would like to point out though is just because the interest rates are not moving does not mean that this information isn't getting taken into account.
Okay.
And especially when you look at your point finding number 3, it could be that firms are taking on more debt, which you show. As a result of firms taking on more debt, you would expect interest rates to go up.
True.
But you don't observe interest rates going up because the capitalization somehow makes the firm seem less risky, all else equal. And so then these two effects are counteracting. And I think you should really consider this. Are you familiar with this contemporaneous working paper by Ben Lurie at UC Irvine and some other co-authors?
No, I'm not.
Okay, so they have a paper where they show that after ASC 842, they look at internal bank ratings. They get some internal bank rating data, and they show that the bank risk goes down after ASC 842. So internally, banks think the firms become less risky, and they have a pretty nicely identified sample where they use staggered fiscal years to identify this.
Yeah.
So they show that risk is going down. You guys are showing that debt is going up. You're showing that covenants are going up, and you're showing that interest rates are staying flat. So what this suggests is that all these margins are getting adjusted, and they're kind of canceling each other out. And so I think you should incorporate that. It's a very interesting finding, and it's consistent with your results.
Yeah.
Yeah.
I'll definitely look it up. Although I don't think we're saying that interest rates don't go up. We're just saying how interest rates are accounted for, right? In terms of lease expense and capitalized leases. That difference is not moving.
Okay.
It's not so much the absolute direction. Or absolutely, interest will go up, if things are not as good as before, right? But which factor, the balance sheet one or the income statement one, dominates? That's what we try to do. It's not the absolute, but the relative. Yeah.
It may be worth taking a look at the absolute interest rates then.
Sure, absolutely. Yeah. Thank you. Appreciate it.
Stephen, you can go ahead.
Yeah, I guess I'm grappling with something basic here. Possibly there's no information provided as long as you do your work. It's sort of the statement that you don't need the balance sheet and income statement if you have the general ledger and just all the transactions. All the information's there, you can put it together. But what accounting does is summarize that in a systematic way, parsimoniously to help you with your work. So the fact that now it's on the balance sheet and I can go to the bottom line for debt and say, here is the debt, and just take it off, understanding there's nothing missing, rather than, or even what a return on assets. I have the assets booked. That seems to be a function of accounting that's going to help me, rather than actually have to go back and do all the capitalization and so on.
Yeah, absolutely. I think that's what most people, including me, would think prior to doing this project, right? You would think if something is on the balance sheet, it's got to be something nice about that, so you can derive extra information from it. But
we use summary numbers for the financial statements, okay, as indicative of something, and we like to have sort of most of the components of those summary numbers there, in the summary numbers, without having to go and do some extra work.
Sure. I guess then the question is, the amount of information you get from this summary measure, would it be greater than the amount of information you would get if you were to simply get it from not this summary measure, but the measure of the income statement?
Well, I have to do some extra, all I have to do is do some extra work, like Kailesh was doing at Citi before the new operating lease standard. So I can, if I go through, I just scrape off a number and saying that's good. There's nothing missing from this number. Okay, if I can't just scrape the number, but I got to go scrape the income statement, as you say, and do it. It just seems like the account's is serving me by giving a good summary number.
Yeah, I guess yes. I guess I think we know that it's a good summary number, but
well, I think there's also the point for sort of naive investor, I guess. How much debt is there? Okay, well, I'll go to the balance sheet and see how much debt there is.
So what do you think about?
And I understand. I mean, I understand there's a number in the income statement. I can sort of rely on the summary number.
So a lot of the opposition to ASA 42, right, especially in the early phase of the process, comes from smaller companies, right, who argue that capitalization is not as simple as people would think. It may be less costly for big companies, but it adds a lot of work to smaller companies. And that's what they argue, right? And then you add those extra layers of subjectivity and judgment involved in setting the discount rates and whatnot. So this is based off what smaller companies and regional banks were arguing during the SEC comment, not the SEC, the FASB's comment process. But point well taken. Thank you, Stephen.
Steve, go ahead.
The amount of regulatory energy expended on leases is really off the wall. It's probably before you were born they were debating it.
1940, 1950.
And you're continuing to debate it today and revisiting it. Why are we seeing such a abundance of regulatory energy, if I can say it that way, and the politics that ultimately went into the solution in this pronouncement? Are we missing something in how we promulgate accounting pronouncements?
Yeah, I guess that's a great question. I'm a little bit too, I wouldn't say young, kind of approaching that age. But my understanding, based on what I read while doing this project, is that this lease accounting started, the new lease accounting standard really started as a joint project, right, between IASB and FASB.
Way before that.
Both organizations, and they both wanted to push this balance sheet approach accounting to the forefront, and they are continuing to do it. Somewhere in the process, the FASB and IASB diverged. So IASB went all the way. So under IFRS 16, the new lease accounting standard under IFRS, there's no distinction between operating leases and finance leases. Everything is finance leases, right? So they put everything onto the balance sheet, and they're going to amortize, right, all these assets, and they're going to expense the interest expenses. FASB, because of the amount of pressure they receive from everybody, right, they sort of, met halfway. So they didn't go all the way to putting everything onto the balance sheet, but they put operating leases on the balance sheet. But in terms of income statement recognition, they continue to expense operating leases over straight line basis, instead of what IASB is doing now, amortizing and doing interest expenses. So the little information that I know about. I don't know much more than what what I'm talking about now. I guess that's the sort of the gist of what happened. Yeah.
By the way, do you think we should mark to market for changes in interest rates?
You mean for leasing, or just in
Yeah,
general?
the leases.
What do you mean by changes in
Interest rates was zero for a period of time. That would have affected the old debt on the books if
That's
we
true. That would not. I don't know. I think that again goes to the fair value thing, right? I don't think that would be a great idea to do that for leases, because you have a contractually agreed upon fixed payments over time, right? So if interest rates are too volatile, then it will be premature to market just because interest rates are moving up and down, right? It would be better to just match, right, expenses to revenue, as is currently being done on the income statement.
So Stephen, we have about like 90, we have 90 minutes left. Maybe you want to move on to the presentation. Yeah.
Okay. Thank you all for the comments. They're very helpful. We definitely need to go back and think about how we want to definitely tone down, what we want to state. I think the last thing in which we fit with ADPs, what ADP tries to do is we sort of get to the interaction of private contracts and accounting regulations, right? How private contracts can be designed and modified to find accounting measures that are not necessarily conforming to what FASB or accounting regulations mandates, as we saw earlier in the contractual definitions of these expenses. So now I'm going to spend a little bit of time talking about the two hypotheses. The first hypothesis is the informative lease expense hypothesis, which basically states that periodic lease expense provides sufficient information to private lenders to assess lease risk. And for several reasons. First, we know that firms recognize operating lease expense in income statement as part of operating expenses under both the new and old accounting regime. Lenders can easily use those numbers, plug those numbers out, feed those numbers into their pricing models, right, if they conceive of those measures to be helpful. EBITDA is also frequently used in loan contracts. And we argue that this preponderance of EBITDA in loan contracts is another piece of evidence suggesting that lease expense is important. Like I said earlier, lenders are willing to strip out the amortization, the taxes and everything, but they're still not adding back, right, the lease expenses to earnings. The second argument is what a lot of companies expressed during the FASB's common letter process for ASC 842. Capitalizing future lease payments, as argued by many companies, are subjective. In contrast, the periodic lease expenses are contractually agreed upon. They are often fixed. There are variable lease payments, but generally speaking, you think about your car leases, apartment leases, right? These are fixed payments and very easy to audit. By contrast, managers have a lot of discretion for what discount rate to use and how certain they believe that they're going to renew their leases once it is expired, because that also matters to how you calculate capitalized operating leases. So here I'm just showing you one example of companies talking about how capitalization would increase the complexity of lease accounting and promotes subjectivity that can lead to less reliable and less relevant financial information. And I think the third point is also very critical. If you kind of think about this matter from the lender's perspective, what do lenders really value when it comes to lending, right? It's whether or not they can recover the losses if the borrower defaults. And in that respect, the so-called operating lease assets represent no collateral value for lenders at all. Under the US Bankruptcy Code, leased assets are not property of the debtor. That is, if you are, let's say, you don't own that piece of equipment that you lease, and if you default, you're going to have to return that property that you lease, not to the lender, to the lessee. So that leaves lenders on the hook. So essentially, there's no collateral value to be derived from leased assets. So that's the third argument that we put forth in support of the informative lease expense hypothesis. And here's the model that we found, as Aeon and Klaus have alluded to earlier. So we basically do a force rates test. We regress low interest spread on two alternative measures of operating leases, lease expense, and lease liabilities. And how do we calculate lease liabilities? So we follow prior literature and basically calculate a discounted value of future lease payments as disclosed in financial statement footnotes. So that's the current lease expense, not the current one, but lease expense from year 1 to year 5, discounted to the present value, and all the remaining future lease payments beyond the 50th year, again, discounted to the present value. We also include capital leases or finance leases as defined under FASB rule, just to control for the potential impact of capital leases on low interest rates. So we also examine whether ASC 842 adoption could affect how lenders price those two alternative lease measures. We introduce a post-dummy, right, indicating whether a loan is issued after ASC 842 was adopted to the model. The coefficients of interest in this model would be those on the two interactions, right, between post and the measures. So we're going to start with a very simple Pearson and Spearman correlation. You can see lease expense and the lease liabilities are pretty highly correlated. Okay, so that kind of suggests that but there's still about 25% that is not correlated. Okay, so there might still be some extra information to be derived from lease liabilities that may not otherwise be available from lease expense alone. I also want to bring your attention to the positive correlation between all three lease measures and loan spread. So that suggests that lenders do price operating leases or lease in general as if there's something that poses, it is something that poses higher credit risk. So in general, if you have more leases, you have to pay higher interest rates on your loans. And here's our main model. We're going to start with model 1, 2, 3. So in model 1, following what a lot of prior literature does, we only include operating lease liabilities, the balance sheet measure, into the model. In the second model, we replace lease liabilities with lease expense. In the third model, we dump everything together. Interestingly, when you replace operating lease liabilities with lease expense, going from column 1 to column 2, R squared actually goes up a little bit. But in the minimum, there's no difference. Okay? So when you replace lease liabilities with lease expense, nothing seems to happen. When you include both measures together, adjusted R squared doesn't move either. Columns 4, 5, and 6 further add firm fixed effects to the model, and the results are pretty similar. In column 6, when we have firm fixed effects, least expense takes on the positive significant sign. Least liabilities, not so much. And in column 3, even worse, right? When you don't include firm fixed effects, least expense takes on the positive sign, which is expected, but least liabilities actually takes on the negative sign. Well, what might be the cause for that? So we conjecture that the negative coefficient on least liabilities in column 3 might be due to discount rate. Okay, imagine if you have a low discount rate. What that would do is you would drive down our dependent variable spread. And because discount rate is in the denominator, when you calculate lease liabilities, it will drive up lease liabilities. So it's almost as if it's mechanical, right? That potential impacts of discount rates would drive this negative coefficient on lease liabilities. So that's pretty much the gist of our paper right here in this table. Okay. We further.
I even has a question on that, I think.
Sure.
So by the way, I think the column 1 result is very cool, and then really kind of like related to our earlier discussion about predictability and also how easy to predict future lease payments. I think you can consider kind of partition your sample based on how stable how likely the future lease payments will be. Exactly, closer to the lease expense today versus other firms are expanding, they probably will have a different future lease payments. Then that's the time that potentially column 1 and 2 will have different results. The column 3 is just some symptom for multicollinearity, because previously you showed us these top two variables are highly correlated with a correlation about 0.75 or 0.72. And whenever you put both of them in a regression, this is what you see. Both are significant building signs. Yeah.
Yeah, absolutely. So that's a good idea. So kind of partition your sample based off, how certain those lease payments might be, right? So that's something we can definitely try. On column 3, yeah, I agree. It could be due to multicollinearity. There's still that 25% non-overlap, right, based on the earlier Pearson correlation table. I wonder, whether this negative coefficient on only slide, sure, it could definitely be due to multicollinearity, but I wonder how much of that is coming from that 25% non-overlap, right? In that, so going back to Stephen's earlier comment about usefulness, maybe in some way these liabilities will be useful. It's just that maybe based off the statistical methods or the statistics that we see, we don't seem to be able to extract or tease out that usefulness that might be available in lease liabilities. So that's the limitation of one of the limitations of what we do. Yeah. Okay. So we also looked at if and how the implementation of ASC 842 might have affected our previous result. And the results suggest that no, it didn't affect our previous result, right? The coefficient of the two interactions terms that are of interest, post times lease expense and post times all lease liability, they're both insignificant, suggesting that private lenders, at least private lenders, we can speak to other financial statement users. Now, interestingly, what we found out is that in the latest conceptual statement by FASB, that they used to have lenders, private lenders, as part of the targeted users of financial statements laid out in conceptual statements. But it seems as if private lenders were taken out of the targeted financial statement users in the latest, in the new conceptual statements by FASB. So that seems to be consistent with, it seems that the private lenders don't really get bothered by ASC 842 implementation. So the last thing, last but not least, we dive deep into the weeds of how contracts actually go about defining operating leases. So we looked at about 800 debt covenants. So we manually examined the contractual definitions of lease in each and every of those contracts. And we found that out of these 800 plus contracts, less than 10% of contracts include capitalized operating leases in debt. And among these 75 contracts that do include capitalized operating leases in debt, about half of them simply multiply lease expense by a constant number, like 7 or 8 or whatever, right? But this practice definitely has gone away after ASC 842, because now companies must actually report the discounted value of capitalized operating leases. So you don't have to multiply lease expense by a constant number. You can just simply refer to what borrowers would report on their financial statements. We found about 25% of those contracts include fixed charge covenants. So fixed charge covenants usually would include lease expense and interest expenses, basically amounts that borrowers are scheduled to pay period by period, right? Interest, leases, and everything. And among these covenants, about 42% include lease expenses as part of the fixed charges. And more importantly, we randomly inspect about 200 loans in our sample. Almost 100% of those contracts, like I said earlier, would not add back lease expenses to earnings, suggesting that lenders do want to use lease expenses, right? When they either when they design contracts or when they price loans. Okay, so we believe that our loan pricing results, in addition to what we see in those contracts, provide some support to our argument that lease expense might just be sufficient enough for lenders to price these risks. So in conclusion, we find that although lenders are sophisticated institutions, they're astute enough to know about capitalizing leases. It seems as if they prefer lease expense. Seems like our results are contrary to the conventional view that lease capitalization provides significant benefits over previous GAAP. Whatever the benefits are, there could well be benefits. They might not be significant enough, right? Maybe we're just not discovering the benefits as of now. Maybe the benefits will reside in markets that are outside private lending. Maybe we'll find information benefits from securities or product bonds. Okay, so thank you very much for your generous feedback and comments. We'll definitely go back and try to incorporate what was asked and talked about today. Okay. Our next event is on February 21st. Professor Paul Griffin will be talking about share buybacks and earnings management, replication, and extension.
Great, thank you, Wei.